Today in this video we will be starting with a new unit from the module D, that is related to the analysis of financial statements. And this unit is going to be quite important because many of our questions are asked from this unit itself. So kindly please do confirm the audio video quality so that we could proceed. And further, if you are new to our channel, please do subscribe the channel. Press the bell notification icon so that you get updated whenever we upload the new video. The full course videos are available at our website iibf.info. Just do visit the website, enroll the courses over there, and further start preparing for the same. The CAIIB case study sessions will be starting from tomorrow onwards. The timing would be 7:30 p.m. in the evening. And further, we'll be covering 2 to 3 case studies on daily basis, and we'll be covering 50 plus case studies by end of this month itself. So please do confirm the audio video quality so that we could proceed. And further, if you want to join us on our WhatsApp group, you have to WhatsApp us writing your name, mention CAIIB along with it, and WhatsApp it to the number 83609444207. We will be adding you to the appropriate group. So audio video quality over here seems to be working very fine. So let us start the session now. So it's related to the analysis of financial statements. Now what it actually relates with the financial statement. Now, whenever we talk about the balance sheet, profit and loss account, the trading account, all these are basically related to the financial statements. And why analysis of these financial statements is important? Because being a banker, we need to look through the repaying capacity of the borrower. We need to check the viability of the project. We need to check the net worth of the capital. And these all factors can be ascertained from the financial statement itself. Okay. Now, first of all, what is actually the net worth? What is net worth? So net worth of the applicant is excess of the assets over the liabilities. So when your total assets are greater than the liabilities, in that case, that's the net worth. So net worth basically helps us the bank to decide, so as to check the level of the activity that the bank is basically deciding to finance. Okay, so whatsoever the level of activity that is basically desirable by the applicant over there, whatsoever the amount that can be lent to the person, that can be ascertained by way of checking the net worth of the applicant. Second, it is related to the repaying capacity. Definitely, you can look into the repaying capacity, that what amount the person can do spare, and that we can go through and further can ascertain by way of examining the financial statements over there. Then third, it is related to viability. So whatsoever the project that is going to be undertaken by the firm itself, would it be viable enough? Can it be a reality? Okay, so that all can be ascertained by way of the financial statements. And it is related to availability of the securities. The audited financial statements indicate the type of the charge on the assets of the borrower. So what type of charge is created on the assets of the borrower? Bank can assess the level of the unencumbered securities so available. Now what is unencumbered? Unencumbered means those securities on which none of the charge is created. Okay, so these are the aspects over there. And further, which are the financial statements? So which financial statements are there? So it is related to the balance sheet, it is related to the profit and loss account, and apart from this, auditors report, explanatory schedules, notes on accounts. So there are actually we can say the balance sheet and for the profit and loss account. These are the main statements over there. And other than that, there are different schedules. There is the auditor's report, and further footnotes are over there, which basically narrate each and every detail over there. Okay, and other than that, we are having the fund flow statement. These are also basically useful so as to determine that funds, how the funds are flowing in the firm itself, how the funds are basically the inflow of the funds and outflow of the funds. And cash flow statement is also there, which let us know what is the actual position of the cash. So we will be discussing them all in detail over here, do not worry about that. Okay, so we will be discussing each and everything over there in detail. I'm just giving an overview that what financial statements are there. So we have covered that there is balance sheet, there is profit and loss account, there is cash flow statement, there are different schedules, there is auditor report, there is fund flow statement. And other than that, we are having the different standards, accounting standards are over there, which basically make it mandatory for some of the organizations. And for which organizations? Such organizations which are listed on the stock exchange. And further, which organizations are having the turnover for the accounting period above rupees 50 crore, they also to prepare the cash flow statement that is related to the accounting standard 3. So it's mandatory for those organizations which are listed on the stock exchange, or who are having the, or which organizations are having the turnover greater than 50 crore. Okay, that is where and they have to maintain they have to prepare the cash flow statements too. And also they have to segment wise reporting. They have to do the segment wise reporting. So whatsoever segments are there, whatsoever the different industries dimensions are there, they have to report accordingly. Okay, now let us have a look at the users of the financial statements. So who require the financial statements? Financial statements are meant for whom? These are meant for creditors and lenders. So if you want to lend to some person, definitely you want to look into that what is his repaying capacity, what are his financials. Investors also do require. It's important for the government agencies too, because they want to ascertain the taxes over there. Rating agencies, which basically do rate the different products and further the instruments, and then it is related to customers. So being a customer, if you are associated with some bank, definitely you are maybe interested in the financials of that particular bank also, because you'll be worried enough now that if your money is safe with the bank or not. And also the employees who are working with the team itself, general public, analyst. So these are the users of the financial statements who do require the financial statements. Okay, so let us have a look at the basic concepts that are used in the preparation of the financial statements. First of all, it is the entity concept. Now the entity concept says that business is considered separate from the entity itself. It is basically a separate entity from the promoters, investors, shareholders, etc. So it's as per the entity concept. It's as per the entity concept that business is a separate entity. So if we say that person A has invested and further has basically incorporated an organization over there, so we'll be saying that ABC organization is separate from person A over here. That is actually the entity concept over here. So whatsoever the capital which has been basically invested by person A, that's a liability. That's a liability for the firm ABC. Why the capital is a liability? Because it's a liability on the firm that it has to repay the amount back to the promoters, back to the investors over there. Then it is a money measurement concept. The second concept that is used in the preparation of the financial statements, that is a money measurement concept that is related to accounting is done only for those transactions. Accounting is done only for those transactions which can be expressed in the monetary terms. Which can be expressed in the monetary terms. Only those transactions can be basically taken in the accounting. So if you cannot measure anything in money, those transactions will not be acceptable in the accounting itself, because those will not be comparable. If you have measured the term, if you have measured the assets or liabilities in terms of the monetary funds, in that case you can do compare them. That is the second concept. And the third one, it is related to the going concern concept. So whensoever an organization is incorporated, it's incorporated keeping that particular thing in mind, that it will basically remain there for a longer period. It is going to be a going concern, that it will be basically continue to business for the indefinitely long period. And that is a going concern concept. Then it is a cost concept. Then it is related to cost concept. The cost concept says that whatsoever the assets that will be acquired by the firm itself. If I do consider the XYZ firm over here, and if I say that they have do purchase a machinery over there, in that case, what does it signify? That this particular cost of the machinery, that this particular asset will be basically recorded at what price? It will be recorded at their cost. It will be recorded at the cost over there. So as the unrealized profit is not accounted for, and if no cost is incurred, if the item is not to be taken into the books itself. So what does it say actually? So it says if there is unrealized profit, it is not accountable for. And further, if you have received machine for free, it will not be basically taken as an item into the books over there. Is that clear? Is that particular part clear over here? Further, the next concept, it is a conservation concept. It is related to the conservation concept. It states that no profit should be anticipated. So if you have any profit that is anticipated, let me give an example. Let us say the case that you just received an order amounting rupees 2 lakh. You just received an order amounting rupees 2 lakh. Now this is basically an anticipation that you will be receiving rupees 2 lakh on completion of the order. It's just an anticipation. You are basically not a rightful owner so as to receive rupees 2 lakh right now. So that profit is not to be accounted for. But if there is any anticipated losses, those must be booked. If there is any anticipated losses, that must be booked. But if you're having anticipated profits, those are not to be accounted for. That is basically the conservation concept. Then it is a dual aspect concept. Now the dual aspect concept is actually very, very important from the balance sheet point of view. What it actually basically it concerns with, it says that each and every entry is having dual aspects. It is having the dual aspects over there. So if I purchased a machinery, it will basically increase the amount under the asset account. It will basically increase amount under the machine account over there, and also my cash account or the bank account will be lowered, or my cash account or bank account will be lowered, because I must have paid either using the cash, or I must have paid using my bank account, or I must have basically taken the machine on credit itself. Okay, so it will be basically covering two accounts. Each and every statement will be having at least two accounts associated with the entry itself. Okay, further it is related to the accounting period concept. It is related to the accounting period concept. The business is segmented into appropriate parts to check the performance. Now, if you do not basically take into account the accounting period, you will be basically accounting for a longer period. Okay, right now if I say the accounting period is from 1st of April to 31st of the March. Okay, but if I say there is no accounting period, and further if you want to compare, how you will be comparing with your performance itself, and how you'll be comparing with the industrial performance itself, it will be quite difficult. Now that is why the accounting period concept is there, that the business is segmented into appropriate parts over there, and such segment is called what? That is called the accounting period. Then it is an accrual concept. That the income or expense to be recorded as when they become due and not on transaction basis. So if I say that the interest was charged, interest in the loan account was charged on 31st of March 2021, the interest charged was basically interest was charged in the loan account. Now, when the interest is charged, it is basically bank become the rightful owner, because when the interest became due on this particular date, the bank will become the rightful owner so as to receive this interest. It is not the case that the customers have paid the amount. It might be the case that the customers have not paid the amount. But even if the customers have not paid the amount, because the amount is now due, now the bank is basically a rightful owner so as to receive the amount. So that basically means what? That basically means that the accrued amount in the loan when became due on 31st of the March, the bank can basically take this particular amount in the profits over there. Are you getting this particular point? Let me clear this to you again. So if I say that the interest was charged up to 30th of March, interest was charged amount rupees 10,000. 10,000 was interest was charged, but it was accrued interest. It was accrued interest, but not yet due. When the interest is accrued, that it is basically accumulated over the interest, accumulated again and again over the period, but the bank basically the interest never became due till 30th of March. Okay, in that particular case, the bank is having no right to receive this 10,000. The bank is having no right to receive this 10,000 amount. Okay, but on 31st of March, this interest became due. Now bank will be becoming what? Bank will be becoming a rightful owner. The bank will be becoming rightful owner so as to receive the interest. Now the bank can basically account this interest accrued for its profit purposes. Okay, so that is a concept over there. That is accrual concept, that the income or expense to be recorded as when they become due, and not on transactional basis. Is that clear? Then it is a realization concept. That revenue can only be recognized once the earnings associated with the revenue have been delivered or rendered. So when you have delivered or rendered the services, only then the associated revenue can be basically recognized. Associated revenue can be recognized only when you have earned it. Earned it, not before that. Okay. So when you have basically delivered the goods or you have rendered the services, only then you can basically recognize your earnings over there, revenue over there. Then it is related to the matching concept. So incomes and expenses in accounting period must be recognized as and when they accrue, and not when they are received or settled respectively. What does it indicate actually? So if I have paid on January 10th, I paid rent for the whole of the year. I paid rent for 12 months over there. Now, as per the accounting period, the accounting period will be till 31st of March 2022. It will be till 2022, and the next accounting period would be related to the financial year 2022-2023 and not to the previous financial year. Okay, so for the financial year 2021-2022, only 3 months would be accounted for, that is January, February and March, and the another 9 months would be basically accounted in financial year 2022 and 23. Are you getting this particular point over here? Are you getting this particular point over here? Now at that particular stage, this expenditure related to the 9 month rent that you have paid in January itself, that must be accounted for the next year expenses, not in the current year expenses, because otherwise it will not give you the clear picture of the profits over there, because this particular expense related to the 9 months of the advance rent is not belonging to current year. It will be basically accounted in the next year itself. It will be basically accountable in the next year itself. That is a matching concept itself, that says that the incomes and expenses must be recognized as and when they accrue and not when they receive or settled respectively. Okay, then it is related to the legal position regarding financial statements. So format, if we talk about the format over there, for banking companies, the format for the balance sheet and profit loss account is prescribed as per the Banking Regulation Act. And for the private banking companies, the format is also prescribed as per the Companies Act over there. And for the, let us have a look at the look at over there horizontal format for the balance sheet. The horizontal format says on left hand side you are having the liabilities, on right side you are having the assets, and the total of the assets will be equal to the total of the liabilities over there. So we will be covering the horizontal format in detail over there. And also let us have a look at the vertical format, in which you will be having the sources of the funds, then application of the funds, that is the uses of the funds, and that is basically in a tabular format over there, that is in a vertical format, and that is not in the horizontal format. In this case also, the sources of the funds, that is basically liabilities, those total will be equal to the application of the funds, that is the uses of the funds over there. Now let us have a look at the accounting period over there. Now as per the IT rules, as per the income tax rules, the April to March is considered to be what? It is to be considered as the financial year for the tax purposes. But for the different industries it can be different. And further, the maximum duration of the financial year can be 15 months, and that can be extended maximum up to 18 months, but with the permission of the registrar of companies. Otherwise it is basically 12 months. But for different industries, the different length of the accounting period can be there, and it can be 15 months also, and exceptionally it can be 18 months, but with the permission of the ROC, that is registrar of companies over there. Okay, then it is related to the balance sheet. Let us consider the balance sheet, the horizontal format over here. In that case, I just told you that on the left hand side you are having the liabilities, on the right side you are having the assets. The liabilities are basically the sources of funds. Why these are sources? Because whensoever the capital is infused, whensoever you take a lending, you basically borrow the amount from your friends, colleagues, relatives, or from the bank itself, or it may be any other liability, that is basically forming what? That is the source of the funds. And assets are said to be what? Assets are the uses of the funds. Where do you utilize your funds over there? It may be the case we may have purchased land, building, machinery, or we may have purchased stocks, etc. So these are uses of funds, and these are the sources of the funds. Further, the classification part goes like, on the liability side, first of all, you are having the share capital. First of all, we are having, I'm just drawing it for more clarification and clarity over there. We are having the liabilities, we are having the shared capital. First of all, we are having the shared capital, then we are having the long-term liabilities. We are having the shared capital, then we are having the long-term liabilities. After that, we are having the short-term liabilities, which are also said to be the current liabilities. Okay, now what are the different components of the shared capital? Actually, what is shared capital? Actually, let me give an example. Let us say the case that it's a public limited company which has basically raised the capital by way of issuing the shares. Public limited company is there, which has raised the capital by way of issuing the equity. Okay, now the shareholders will be investing the money into the company itself, and further that will be forming what? That will be forming the capital of the company. That will be forming the capital of the company over there, and that is said to be what? That is said to be the shared capital. Other than that, under the shared capital or the net worth, we are having the other component which are related to the reserves, which is basically related to reserves. We are having the general reserves, capital reserves, revaluation reserves, and further we are having the surpluses over there. If you are having any of the surpluses from the previous year itself, those will be basically forming the part of the reserves and the surplus over there. And under the long-term liabilities, it could be related to the bonds and debentures which have been issued. Could be related to the commercial papers which have been issued. It could be related to the long-term term loans which have been basically extended by the banks over there. Okay, so that is basically related to long-term liabilities. And under the short-term liabilities, it will be the case that you have opted for a working capital from the bank itself, or the CC limit we generally say. Okay, or it could be the case that we are having the sundry creditors to whom basically you are to pay the amount. You're having the liability, you're having the obligation so as to pay the amount. And further it is also related to the bills payable. Now what is actually bills payable? If some party has drawn bills on you and you have accepted it, that is basically related to the bills payable over there. And also any of the short-term durations or loans that have basically taken, and that is basically related to what? That is basically the part of the current liabilities. Other than that, we are having the provisions. I just gave you an example related to that whatsoever the expenses which are basically have already paid in advance. Okay, you basically create a provision for them. You basically create a provision for them so as to create a liability for those purposes. That is basically provision will also form the part of the current liabilities over there. So these are the components related to the current liabilities. So any of the liabilities which is basically due for the payment in the next 12 months, that is basically forming part of the current liabilities. If there is any liability that is basically to be paid beyond 12 months, that will be basically part of the long-term liabilities over there. Okay, and further on the asset side, we are having the fixed assets. First of all, we are having the fixed assets. First of all, likewise we are having the land, building, machinery, etc. That is basically the fixed assets. And further on other asset, we are having the non-current assets. Non-current assets, it may be the case that you have invested the amount, but that investment is not fixed asset type, and also you have invested the amount for a long period longer than 12 months. Because if you have invested the amount, or there is any asset which is going to change its from one form to another in the next 12 months, that will be basically the current asset. But if it is not current asset, current asset in a form that the whatsoever the investment has been made, that will basically last for more than 12 months. In that case, it will be a non-current asset. It will be a non-current assets. Let me give an example. Let us take the case that you have invested into securities. You have invested into the shares which are not quoted. Which are not quoted means what? Which are not listed on the stock exchange. Otherwise, if you have invested the monies into the stocks or investments which are quoted, which are basically listed on the stock exchange, that will be forming part of the current assets. But if it is not quoted, in that case it will be forming part of non-current assets over there. Other than that, we are having the current assets like cash balances, bank balances, stocks, debtors, sundry debtors, bills receivables. All those will be forming the part of the current assets over there. Other than that, prepaid expenses, like already told you that you have paid the rent in advance, that is basically your prepaid expense. That is your prepaid expense. That is also forming part of the current assets over there. That will also form part of the current assets over there. Then it is a case of the intangible assets. Now intangible assets are those which basically do not exist physically, which are not tangible, but that actually create a value, but actually they create a value for your company itself. That is basically the intangible assets, like goodwill, debit balance of profit and loss account, patent, etc. Those are the intangible assets. Those are the intangible assets. Why the debit balance of the profit and loss account is basically under the intangible assets over there? Let me tell you, debit balance of the profit and loss account means it's a loss. It's a loss. Now when there is a loss for the company, actually the company is having the liability. So if I say that the amount was invested by the promoter or owner in the company company over here, the company is having the obligation so as to pay back this amount. But if there is accumulated loss, if there is any loss occurred, in that case the company will be having no liability, or will be having the lesser liability so as to pay the amount. So that is why So that is why it is basically what, whenever there is a loss, it's an asset. That is why it is basically under the intangible asset over there. Okay, and that basically forms what, that basically forms a composition of the assets over there. That is basically the fixed assets, non-current assets, current assets, and further the intangible assets over there. Okay, and if we look at the liability side, we are having the net worth over there, net worth, and for the long-term liabilities and current liabilities over there. Okay, so that was related to the composition of the assets and liabilities. Now let us have a look at those factors in detail. So I just told you that we are having the shared capital, and that is divided into two parts over there. First of all, it is a equity capital, and the other one it is a preferential capital. Now in case of equity capital, it is basically related with the normal share. If you purchase in some company, that is basically related to equity share. But preference share is basically somewhat different. Why it is different? Because in that particular case, you'll be having the preference so as to receive the dividends. You'll be having the preferences so as to receive the dividends. Whenever the dividend will be declared, you preferred so as to amount of the dividend will be paid to you in preference over there. Okay, and further, at the time of the liquidation, when the company is liquidated, in that case also you'll be basically preferred so as to receive the amount over there. That is basically related to preference shares over there. Further, it is related to reserves and surplus. Reserves are of two types: revenue reserves and capital reserves. Revenue reserves represent the accumulated and retained earnings from the profit or of the normal business operations. So whatsoever the business processes or operations were conducted, and whatsoever the amount basically you generated, whatsoever the profit that was generated over there, when you keep aside that particular amount, that is basically part of what, that is basically part of revenue reserves over there. And further, for example, the general reserves, investment allowance reserves, dividend equalization reserves, those all are forming the part of the revenue reserves over there. And when we talk about the capital reserves, it is actually basically not related with the normal operations. So whatsoever the amount that you have basically kept aside, and that amount is particularly not generated from the normal operations, that is basically forming what, that is forming the capital reserves over there. For example, revaluation reserve. Now what is actually revaluation reserves? Let me give an example that a piece of land was purchased by you in year 2002. Piece of land was purchased by you in year 2002, and that was purchased for amount rupees 2 crore, and that was purchased for amount rupees 2 crore. And when you revaluated this particular piece of land in 2021, in 2022, now it is worth rupees 22 crore rupees. Now it is worth rupees 22 crore rupees. Now there is revaluation value increase in the value of the land. There is increase in the value of the land on revaluation basis. Now in that case, 20 crore will be forming the part of what? 20 crore will be forming the part of the revaluation reserve over there, because there is no addition, there is no extra addition over there, but there is a liability that has also increased. So there is increase on the asset side also, in the fixed assets also, and also there is a liability side also increased in the form of the revaluation reserves over there. Is that particular part clear? That is basically related to the reserves and surplus. Okay, and surplus is the balance in the profit and loss account which has not been appropriated. If the balance is not appropriated, in that case it will be forming the part of the surplus. Like if I had the profit for the last year, if I had the profit of rupees 100, and out of rupees 100 I basically kept aside rupees 20 for the dividend purposes, and for the rupees 60 for the reserve purposes. For some particular reserve I just created, or general reserve was created, still I got rupees 20. Still I got rupees 20. In that case, rupees 20 will be forming what? Will be part of what? It will be the part of the surplus. It will be forming the part of the surplus over there. So that is related to what? That is related to the reserves and surplus. Further, it is related to secured loans. Secured loans. Now, which loans are basically categorized as secured loans? Those loans on for which the borrower has basically has created a specific charge on the securities. That is said to be what? That is said to be the secured loan over there. Like if a loan against a mortgage or debentures over there, that is basically secured loan. And which part is said to be what? Unsecured loans over there, where no specific security is provided. Where no specific security is provided for the firm's borrowing, that is said to be what? That is said to be the unsecured loan. Okay. Then it is related to the current liabilities. Current liabilities, those liabilities I already told you, those liabilities which are to be paid in the next 12 months, that is said to be what? That is said to be the current liabilities over there. Then on the asset side, we just already categorized in the fixed assets over there. Further, we are having the investments, like if the investments are securities in which you have invested the amount, if those are not quoted, that will be forming the part of the non-current assets. That will be forming the part of the non-current asset. I already categorized the asset side for you as fixed assets. We are having the non-current assets, current assets, and intangible assets. Okay, so these were the categories over there. Next, it is related to the current assets. So assets which basically evolve themselves. What do you mean by evolve? That they will be changing the form from one form to another in maximum 12 months. That is basically related to what? That is related to the current assets. Those assets which are basically utilized for day-to-day operations of the entity itself. Those are the current assets, like cash balance, bank balances, sundry debtors, or we can say bills receivables, prepaid expenses. All those will be forming the part of the current assets over there. And also stocks are example of the current assets. Then it is a case of the intangible assets, which do not exist physically but are having a value for the company itself. That is a goodwill, patent, copyright, preliminary expenses. Now, what are preliminary expenses? Those expenses which were incurred so as for the registration of the firm itself. Those are basically forming the preliminary expenses. Loss incurred by the entity, it's also an intangible asset. I already conveyed the reason to you. Then it is a profit and loss account. Now let me first of all tell you that what is a cycle goes like. So first of all, the trading account is prepared. From where we do ascertain the gross profit or gross loss. Then second one, it is a profit and loss account. From where we do ascertain the net profit or net loss. Okay. And further, the third one, it is related to what? The third one is related to the balance sheet over there, which is basically as on date. So this is a statement. Balance sheet is a statement as on a particular date. Okay. Is that particular part clear over here? Now, profit and loss account is basically maintained. It is prepared so as to ascertain the net profit or net loss. So there are some terminologies that you must be understanding so as to understand the financials. Okay. So first of all, it is related to what? First of all, it is related to the gross and net sales. Now, what do you mean by gross and net sales? So if I say that I have basically sold the goods worth rupees 20 lakh. If I say I have just sold the goods for 20 lakh, not worth rupees, I just sold the goods 20 lakh for 20 lakh rupees. In that case, that will be my gross sales. That is my gross sales. And when I do subtract the excise duties from the same, that is forming the net sales over there. So total price of the goods sold. Whatsoever the goods you have sold, for what price you have sold, that is basically the gross sales. Okay. And when you subtract the excise duties from the same, that is forming the net sales over there. Then it is a cost of goods sold. It is related to the cost of goods sold. So let me give an example that if I purchase the raw material for 20 rupees, for the labor was there, rent that I paid for the building, electricity bill that I paid for building, all these are costing me rupees 8. Now I sold it for rupees 45. Now this is basically related to what? This is basically related to the sales. Over there. And further, these factors are related to the cost of goods sold. This is basically related to cost of goods sold. Okay. So cost of goods sold, this is a sum of cost incurred for manufacturing the goods. Okay. So whatsoever the goods, those were sold during the accounting period, and what cost was associated with those goods, that is the cost of goods sold. Okay. It consists of the direct material cost. It basically consisting only and only of the direct material cost. We have only covered the cost of the product itself. We have not covered any marketing expenses, any labeling expenses, or any other things. We have just covered the material cost, labor cost, and factory overheads. What do you mean by factory overheads? Whatsoever the rent was paid, whatsoever the wages were paid, whatsoever the electricity cost was paid, Okay, that is basically related to the factory overheads over there. And further, it is different from the cost of production, which represents the cost of goods produced in the accounting period. Okay, so cost of production is different. Cost of goods sold is different. Cost of goods sold is actually related to whatever the goods we have sold during the accounting period, the cost associated with that. And cost, basically the production, cost production is basically related to what? Cost of goods produced is basically related to what? It is basically the cost of production is related with the, represents the cost of goods produced in the accounting period. Cost of goods produced in the accounting period. Is that clear? Then it is related to the gross profit. The next term that we are going to cover, it is a gross profit. Gross profit is ascertained from the trading account itself or the manufacturing account itself. Okay, so this is the difference between the net sales and the cost of goods sold. This is the difference between the net sales and cost of goods sold. So if I say that I purchased some amount and opening balance is there, and further there are the direct cost associated with it. Okay, and on the right side, I'm having the sales. If I say sales, if I say, in that case I'll be asserting the gross profit or gross loss. Okay, so gross profit is equal to what? It is equal to sales, the total amount I just sold the goods for, minus the cost of sales, minus the cost of sales or cost of goods sold, or cost of goods sold. That is basically related to what? That is the gross profit. So I'm writing this over here, that gross profit is equal to what? It is equal to the sales minus COGS. Okay, cost of goods sold. That is basically the gross profit. Next term, it is related to operating expenses. Now, what is operating expenses? Now, what are operating expenses? One cost that you basically understood over here, that was related to the direct cost or the direct cost in product manufacturing. That is basically being covered under the, trading account. I have told you na, first of all, we do prepare what? We do prepare the trading account first of all. Then we do prepare the second one, that is a profit and loss account. Then it is the second one, that is a profit and loss account is prepared. Okay, now from here we do a certain, from the trading account we do a certain the gross profit or gross loss. Okay, and from profit and loss account we do a certain the net profit or net loss. Now over here the profit and loss account actually starts with what? It basically starts with the gross profit or gross loss. First entry goes like gross profit or gross loss first of all, and further we'll be basically looking into the different indirect cost associated with the product itself. So in the trading account, we basically cover the direct costs only. We basically cover the direct associated cost only. Okay. And in the profit and loss account, we'll be covering the indirect cost. Now, what will be the indirect cost? When you have manufactured the goods, it may be the case now that you'll be basically marketing them. You'll be administrating them, you'll be selling them, distributing them. There will be cost associated with it. And also, if there is a depreciation being charged, that is also a cost that is associated with the manufacturing itself. So that is basically the operating expenses. That is basically related to the operating expenses over there. Then it is a operating profit. Then it is a operating profit. So gross profit minus operating expenses. Gross profit minus operating expenses, that is the operating profit. Now this is not actually the net profit. This is not the net profit because this is not the overall profit of the organization. Nah? This is not related to the overall profit of the organization. But this operating profit is actually related to that whatsoever the main business I'm having and what I'm generating from that particular business line. Okay, so that is basically meant by the operating profit over there. That is meant by the operating profit over there. Let me give an example that over here, I just purchased the goods. I purchased the goods worth rupees 50 and the direct cost associated with the good production, it is basically rupees 30 and I sold it for rupees 130. That is basically a sales over there. That is a sales over there. Okay, that is basically 130 over here. In that case, what will be the gross profit? Now now over here the gross profit will be equal to what? It will be equal to rupees 50. If I'm not wrong, it is equal to rupees 50. Now this is basically representing what? This is representing my gross profit. We do a certain gross profit or gross loss under what account? Under the trading account. Under the trading account, we do a certain the gross profit or gross loss. And the second one, basically from this gross profit itself, we will be basically subtracting the, from gross profit, we'll be subtracting the indirect cost associated with the product operations. that is the operating expenses. So we'll be subtracting the operating expenses. I'm just writing indirect cost, or we can do mention it operating expenses, so there is no confusion. So indirect expenses will be subtracting from the gross profit itself. So that will be basically the operating profit, that is not equal to the net profit, that is equal to the operating profit only. That is basically the part equal to operating profits only. Is that particular part clear over here? Further, the next term that we are going to cover, it is a non-operating surplus. Now, what is non-operating surplus? Now, if I say that I do manufacture furniture, now that would be my primary business. Now, that is my primary business. So, operating profit would be basically equal to what? Whatsoever the earnings I have made from my primary business line. Okay, so that is my operating profit. Other than that, if I also invested the amount into some shares or something like that, and further I generated funds from that, I generated a profit from that, that would be my non-operating surplus. So whatsoever the investments you have made, whatsoever the securities that you have invested into, in that case, if you dispose of those assets, or you basically dispose of those securities, whatsoever the amount that you will be earning out of it, that will be basically forming the non-operating surplus over there. And further, it is related to PBIT. Now, what is PBIT? It is profit before interest and taxes. It is a profit before interest and taxes. This is sum of operating profit and non-operating surplus or deficit. So this is basically sum of operating profit. This will be SUM, not SOME. So this is sum of operating profit. Operating profit means the profit earnings from the primary business line, and for the non-operating surplus or deficit. And the sum total of these will be equal to the PBIT itself. You have not basically charged any interest cost, or have not subtracted the taxes from the same. That is the PBIT, profit before interest and taxes. And interest is basically what? So whatsoever the amount that you have borrowed from the bank, such as loans, debentures, public deposits, working capital, that is the interest amount that will be charged upon that. And further, it is PBT, that is profit before tax. Then when you have basically deducted the interest from the PBIT, that will be basically giving you PBT. And what is PAT? That is profit after tax. When you have subtracted the interest as well as the subtracted the interest as well as the tax from the PBIT, that will give you PAT, that is profit after tax, PAT. This is also known as PAT, popularly known as PAT, that is profit after tax. Okay, so now these were the different terms associated with the profit and loss account. Already there. So I just told you just over there that we do ascertain the gross profit or gross loss from trading account, and further we basically do subtract the indirect cost or operating expenses from the same, and that gives us operating profits. That is basically equal to operating profits, and operating profits plus the non-operating surplus. Operating profits plus the non-operating surplus, that gives you what? The total of these two terms forms what? This forms the operating profits plus non-operating surplus. Operating profit and non-operating surplus, that is actually the PBIT, that is profit before interest and tax. When you do add interest, when you do subtract the interest, that forms the PBT, profit before tax. And further, when you do subtract the tax, that gives you the PAT, that is profit after tax. Okay, so this is how you need to memorize this. Now let's move further. It's related to the funds flow statement or the cash flow statement. It is related to the fund flow statement or cash flow statement. Now it is actually very much required so as to look into that how your funds are being flowing into the organization itself. Now fund flow is actually related to what? When you are paying the amount, it is a cash outflow, or it is a basically we are not basically looking into the cash factor right now. We are just concerned about the funds over here. So funds outflow, and when the funds are received, this is fund inflow. That is fund inflow. So fund flow statement is financial statement that analyzes the company's balance sheet of 2 years to validate the movement of the funds from the previous year to the current year, that how the funds have flown from last year balance sheet to this year balance sheet. That is the fund flow statement over there. It compares the sources of inflow and outflow of the funds. So during the concerned accounting periods, we will be comparing the inflow of the funds and the outflow of the funds, and definitely we are going to analyze that how this inflow and outflow of the funds is going to affect the working capital needs of the organization. Okay, and further, how these funds are utilized, indicates that how these funds are utilized. And financial analysts, who are financial analysts? Who do analyze the financial statements. Okay, so financial analysts can assess the fund flow of an organization in the near future. So you can anticipate that how the fund is going to be flow in the near future over there. Increase in liabilities or decrease in assets means what? Means increase in sources of fund. Okay, so if there is increase in liabilities, so if I say there is increase in liabilities or decrease in assets, if I say there is increase in liabilities or decrease in assets, what does it, or decrease in assets means what? It means increase in sources of funds. What do you basically does it indicate? So if there was new capital which was infused by the investor or the promoter, in that case the capital will increase. I already told you the different components of the balance sheet over there. We were having the capital, and further there were the long-term liabilities, and further there were the short-term liabilities or the current liabilities over there, or the current liabilities over current, not assets over here, current liabilities, CL, and the current liabilities over there. Okay, and further, when there is increase in capital, the new capital must have been infused either by way of the cash or by way of the bank balance over there. So that will also increase. So increase in capital will also increase the cash flow over there. So increase in liabilities or decrease in assets means what? It means increase in sources of funds, that the liability side has increased. Increase in assets or decrease in liabilities means increase in uses of funds. So if there is increase in assets, and decrease in liabilities, it means increase in uses of funds, that the asset part have been increased. Okay, and that is all related with what? That is all related with the fund flow statement. Main purpose is that you basically do compare the balance sheet of last 2 or 3 years so as to validate the fund flow, and you do analyze the working capital needs of the firm over there. Okay, then it is related to the cash flow statement. Now if I say, so I just told you that we do a certain gross profit or gross loss from the trading account, and then we do prepare the profit and loss account so as to ascertain the net profit or net loss. Now if I say that the net profit of the firm is, 2 crore rupees, does it actually mean that the company will be having 2 crore rupees in hand in cash or as bank balance? Would it be possible? Definitely not. It's not possible, because as per the accounting standards, accounting policies, we also account for the accrual income. I already gave you an example that if on 31st of March 3 crore rupees of the interest that became due, the bank became rightful owner so as to receive the amount of rupees 3 crore that was charged, that was accrued. Okay, but this will not be the case now that the 3 crore amount will be paid in cash. So the cash statement, so the cash structure can be different from the fund statement itself. Okay, that is basically why the cash flow statement is there, must be there, because so as to look into the actuality of the cash so available, that is the cash flow statement. Okay, so because the income statement is prepared under the accrual basis, the revenue reported may not have been collected or turned into cash. Okay, so what does actually it means? That whatsoever the amount that you have basically mentioned in the account, in the statement itself, it should not be the case that you have received the amount in full or that has been converted into cash. Okay, And also similarly, whatsoever the amount that expenses also that was related to the income part, also it may be the case that the expenses reported in the income statements might not have been paid. It may be the case that you have mentioned the expenses in the statements over there, accounting statements over there, but it may be the case that you have not paid the amount so far. Okay, that is also why the cash flow statement must be there. Okay, so the net cash from the operating activities is compared to the company's net income. So net cash from the operating activities is compared to the company's net income. That is, net cash is the cash inflows minus the cash outflow. That is a net cash. That is a net cash. Then it is compared with what? Then it is compared with the net income itself. So if I say I'm having net cash, net inflow and net outflows, net cash that was amounting 5 lakh rupees, that was amounting 5 lakh rupees, and further that was compared with the actual income, which I mentioned at rupees 2 crore, Now if the net cash from the operating activities is consistently greater than the net income, if the net cash from the operating activities is consistently greater than the net income, the company's net income or earnings are said to be high quality. Because if you are basically if it is generally higher, in this case it is lower one, so we'll be saying that the quality of the that it is a lower quality profit that they are generating. It is a lower quality profit that they are generating because they are not able to convert it into cash. They are not able to turn it into cash, or they are not able to collect it. Okay, so that is basically not high quality. And further, as of the second case that I have mentioned over here, that is related to if the net cash from the operating activities is less than net income. If the net cash from operating activities is less than net income, a red flag is raised as to why the reported net income is not turning into cash. That why you're not able to convert your net income into the cash over there. Okay, so that is related to what? That is related to the same. Okay, and for the second, it says if a company is consistently generating more cash, if the company is consistently generating more cash, then it is using, the company will be able to expand its operation, because you will be having money in hand. You will be having money in hand that you can basically expand, that you can basically expand yourself. Okay, replace inefficient equipment, you can increase its dividend, you can buy back the stock, you can reduce the debt. Okay, so if I'm basically, what that actually it means to say that if I'm having more of the cash in my hand, definitely I can use it for the different purposes, like I mentioned over here. That is related to, we can do expand our operations, we can do replace the inefficient equipment, if we can do increase the dividend, we can buy back some of the stock over there, we can reduce our debt, we can repay our debt, or we can acquire another company too. Okay, that is basically the perceived value with the cash flow statement. Okay, and then it is related to the projected financial statements. Next topic that we are going to cover over here, that is the projected financial statements. Now the projected, what do you mean by projected financial statement? That is for the upcoming financial period. Not for the previous one. When you're basically projecting the financial statements for the upcoming financial period, that actually basically you're projecting your activities, that where we do see ourselves in the near future. So if I say for the financial year 21-22, my projections are, my sales would be 2 crore rupees, my profits would be 1 crore. Okay, those are my projections for financial year 21-22. That is basically related to what? That is basically related to the projected annual financial statements. That is related to the projected financial statements over there. And further, these are prepared with the objective of assessing the working capital requirements, because we will be assessing our working capital requirements, that what requirement we may be having in the near future. Okay, that is related to the, that we want to look into the, we want to basically assess the working capital requirement of ours. Okay, that is basically the projected financial statement related with. Okay, in case of existing units, the past financial statements serve a useful purpose to understand the trend. So for the existing units which are already in existence, we can do definitely look into the previous past year financial statements so as to check the trend over there, that how they were working, what were their previous needs. And we can do look that if I say that previously the financial year, in the financial year 2018, the sales were 10 lakh, then in 2019 the sales were 15 lakh, 2020 the sales were 30 lakhs, and in 21 the sales are 50 lakhs, and projection for the 22 it is given to be 80 lakhs. It seems to be realistic. That it can be viable. But if it is given to be 180 in 2020 just for sake of having more working capital from the bank, is it basically does it seems to be viable over here? No, it does not seems to be viable over here. Okay, so that is the main purpose of the projected financial statements over there, so as to assess the working capital requirements for the near future. And also if you're having the previous year record, you can basically examine that and further can compare it with the projected turnovers. Okay, then purpose of analysis of financial statements. What is the purpose of analysis of financial statements? First of all, it reveals us the trend of growth. That what is the trend? Are we profitable or not? Opinion about the management. We want to check that what is opinion? Is the management able to manage properly or not? Is the management able to basically manage the assets or liabilities over there or not? So if we are having current ratio, is actually a ratio of the current assets divided by the current liabilities. Now current liabilities are those which are to be paid in the next 12 months, and current assets are those which will be evolving themselves in the near 12 months over there. That is basically current assets and current liabilities. If the current ratio, that is current assets divided by current liabilities, if that is 36, that is too high actually. What does actually it indicates? It indicates that the management is not able to manage the assets properly. And so that the information that we can also infer, so that to get an idea about the management, so as to get an idea about the efficiency of the enterprise so form. So it reveals the composition of the assets and liabilities too. So what assets are there, what liabilities are there. We can do compare the trend of leverage. What is leverage actually? Leverage means actually if I'm having rupees 10 in my hand and further I borrowed rupees 200 from the market itself, that is basically leverage. And I further invested into the market itself, that is basically leverage I'm using over here. Now that is quite riskier. So more is a leverage, more riskier it is. Okay, so if I having rupees 20 in your hand and you have borrowed rupees 2000 from the market itself and you're investing that particular amount in the stocks or anywhere itself in the market, that is quite riskier now, because you're having not your own funds in the hand itself. Okay, so that is why leverage must be lower enough. We can do compare the trends of the leverage, we can do compare the retention of the profits, and further the financial health of the enterprise also. Okay, for the projection of the future performance. No, I already told you that we can take a look into the projected financial statements over there, so as to look into that what would be the viability, and we can also check it from the trends over there. Financial statement analysis helps in projecting the earning prospects, helps in projecting the earning prospects. So if we look into the financial statements, if I say consistently for the last 5 or 6 years, we are profitable and we are generating decent profits over there, definitely I can predict something from my near future too. Okay, that is basically projection of future performance. And for the detecting danger signals, so if you want to know about some organization, some firm over there, definitely you will be basically digging into the financial statements of the firm over there, so as to dig into deeper, so as to check if the financial fundamentals of the company are strong or not. That is the digging that you're going to do. That is basically you can detect the danger signals from that too. That if I already conveyed if I say that the long-term liabilities are very much higher, long-term liabilities, if I say borrowing from the banks or in the form of the debentures, bonds, etc., it's quite higher. And further in that case we will be saying that it is having the higher leverage. That is a danger signal itself. That's a kind of danger signal itself. Okay, So financial statements do help us so as to detect the danger signals, and further we can also do assess the credit requirements. If some person visits you and further he tells you that he wants to have a working capital limit from your bank itself, then definitely you'll be looking into the financial statements over there so as to assess the credit requirement, at what capital working capital is basically required by the firm itself. So over financing and under financing, both are riskier. If you have overfinanced, that is lending some person more than what he required, and under financing, that lending a person lesser than what he required, both are riskier, because in case of overfinancing he will be misutilizing the funds, and further in case of under financing he will not be able to meet up his requirement. Both are riskier over there. So both are riskier over there, and further that must be looked into. Then further, it is related to the assessment of the credit requirement. I just told you. Then it is related to examine the fund flow. I just told you that if you just look into the fund flow statement or cash flow statement, you can do examine the fund flow over there. Cross checking can also be done. That is statement of stocks, book debts as on the date of the balance sheet submitted by the borrower. You can do cross check the different terms or different figures and facts that were given to you and that were given by provided by the customer itself over there. Okay, so those are the benefits. These are the benefits related to the financial statements over there. So these are the benefits, and this is the purpose of the analysis of the financial statement. Okay, so that would be all related to today video. I hope that you must have liked the video. So if you have liked the video, just do like the video right now, and further do rate the video right now. And if you want to get all the previous videos, just do visit the website iibf.info and further enroll yourself and start preparing for the CAIIB right away. So that will be all related to today video. Thank you so much, and see you again tomorrow at the same time in the evening over there. And further we will also be covering the case study videos from tomorrow onward. Thank you so much, and see you again.